Look, I need you to pay attention to what I'm about to show you, because what's happening right now in the gold and silver markets is almost identical to what happened in 1979, right before precious metals went absolutely parabolic. And I mean that literally. The same patterns, the same institutional behavior, the same monetary conditions. It's all lining up again. But here's what's different this time. Back then, most people didn't see it coming. They didn't have access to the data we have now. They couldn't track central bank purchases in real time. They couldn't see the COMEX inventory levels dropping day after day. They didn't know what was about to hit them until gold had already gone from $200 to $850 in less than 2 years. You don't have that excuse anymore. The warning signs are everywhere, and you have a very small window to act before this thing takes off. Let me walk you through exactly what's happening. Because once you see the full picture, you'll understand why I'm saying you have days, not months, to position yourself. Right now, the gold market is experiencing something that hasn't happened since the late 70s. We're seeing a perfect storm of supply constraints, unprecedented central bank buying, and a complete breakdown in the paper gold market structure. And it's all happening simultaneously. Start with the central banks. They're buying gold at a pace we've never seen before in modern history. We're talking about net purchases that are running at levels that would have been considered impossible just 5 years ago. And it's not just the usual suspects. It's not just China and Russia anymore. Poland is buying. Singapore is buying. India just took delivery of massive quantities. Even countries that have historically been dollar loyal are quietly accumulating physical gold. Why? Because they see what's coming. They understand that the dollar's role as the global reserve currency is being actively challenged, and they're preparing for a monetary system that looks very different from the one we've had for the past 50 years. But here's where it gets really interesting. These central banks aren't buying paper gold. They're not buying ETF shares. They're demanding physical delivery, actual bars. And that's creating a massive problem in the physical market. The COMEX, which is supposed to be the primary price discovery mechanism for gold in the United States, is running dangerously low on registered inventory. We're talking about inventory levels that are a fraction of what they were just 2 years ago. And every month we're seeing more and more delivery notices. More institutions demanding physical metal instead of rolling their contracts forward. This is exactly what happened in the late 70s. The paper market worked fine as long as everyone was content to trade contracts back and forth. But the moment people started demanding actual metal, the whole system started to crack. And we're seeing those same cracks appear right now. Let me give you some specific numbers because this is important. The registered gold inventory at COMEX, the gold that's actually available for delivery, has dropped below levels that many analysts consider critical. We're talking about a situation where if just a small percentage of contract holders demanded delivery, the exchange wouldn't be able to fulfill those obligations without going into the market and buying physical gold at much higher prices. And that's not speculation. That's basic math. The open interest in gold futures is massive compared to the actual physical gold available to deliver. It's a fractional reserve system, and it only works as long as most people are willing to settle in cash instead of metal. But something's changed. The big players, the sovereign wealth funds, the central banks, the family offices managing generational wealth, they're not playing that game anymore. They want the physical metal. And when they start demanding delivery, prices have to adjust to reflect actual physical scarcity, not paper contract abundance. Now, let's talk about what's happening on the supply side, because this is where things get really concerning. Global gold mine production has essentially plateaued. We're not finding major new deposits. The easy gold has been mined. What's left requires more capital, more time, and more energy to extract. And with energy costs where they are, with permitting timelines stretching out for years, with environmental regulations getting stricter, the idea that we're going to see a surge in new supply is fantasy. The mining companies know this. That's why you're seeing consolidation in the sector. That's why the major producers are buying up smaller companies instead of trying to develop new projects from scratch. They understand that replacing reserves is becoming increasingly difficult and expensive. And it's not just about new production. Recycling flows, which normally provide a significant source of supply when prices rise, aren't responding the way they used to. People aren't selling their gold jewelry. They're not liquidating their holdings. If anything, we're seeing the opposite. We're seeing retail buyers in Asia accumulating physical gold at prices that would have triggered massive selling in previous cycles. That tells you something about confidence in the monetary system. When people in countries with recent memory of currency crises are buying gold at these levels instead of selling, they're telling you they don't trust what's coming next. So you've got constrained supply, you've got unprecedented institutional demand, and you've got a paper market structure that's showing serious stress. That's the setup. But there's another element that makes this situation even more explosive, and that's the monetary backdrop. Think about what's happened over the past few years. We've seen the most aggressive monetary expansion in peacetime history. We've seen government debt levels that would have been considered catastrophic just a generation ago become normalized. We've seen the Federal Reserve's balance sheet expand to levels that were unimaginable before the financial crisis. And now we're seeing the consequences. Inflation isn't transitory. It's structural. It's baked into the system through energy policy, through supply chain fragmentation, through deglobalization, through the weaponization of the dollar that's forcing other countries to build alternative payment systems. The BRICS nations aren't just talking about creating a new currency anymore. They're actively building the infrastructure for trade settlement outside the dollar system. They're establishing gold-backed mechanisms for international commerce. They're creating alternatives to SWIFT. This isn't theoretical. This is happening right now. And every time the dollar gets weaponized, every time sanctions get imposed, every time the U.S. uses its control over the global financial system as a geopolitical tool, it accelerates this process. It gives other countries more incentive to find alternatives, and gold is the ultimate alternative, because it's the one asset that sits outside any single nation's control. Let me tell you a story that illustrates what's really happening here. Back in the early 70s, right after Nixon closed the gold window, there was a period where gold traded relatively quietly. It went from $35 an ounce to maybe $150, and a lot of people thought that was the move. They thought gold had repriced for the new monetary reality, and that was that. But they were wrong, because what they didn't understand was that the real move hadn't even started yet. The real move came when the market finally grasped the full implications of a fiat currency system with no constraints, when inflation started running hot, when the dollar started losing purchasing power in a way that couldn't be hidden by government statistics, when people realized that the old rules didn't apply anymore. That's when gold went from $150 to $850 in less than 2 years. That's when silver went from $5 to $50. And the people who waited, the people who thought they had time, they missed it. Because once that move started, it was too fast. The premiums on physical metal went through the roof. Dealers couldn't get inventory. Wait times stretched to months. We're in that same setup right now. Gold has repriced somewhat. It's moved from its lows. But the real move, the move that reflects the full implications of what's happening in the monetary system, that hasn't happened yet. And when it does, it's going to be fast. You can see it in the way the market is trading. You can see it in the fact that every dip gets bought immediately. You can see it in the way physical premiums are starting to expand. You can see it in the delivery demands at the exchanges. All the signs are there. Now, I want to pause here for a second, because if you're sitting on significant retirement savings, if you have $100,000 or more in traditional retirement accounts, you need to understand that there are ways to get physical gold into those accounts without triggering tax consequences. I put together a comprehensive guide on how gold IRAs actually work, how the process works, what the rules are. It's linked in the description. No cost, no obligation. Just information that might be relevant to your situation if you're thinking about how to protect purchasing power in retirement accounts. Worth looking at if that applies to you. All right, back to what's happening in the market, because there's another dimension to this that most people aren't paying attention to, and that's the commercial positioning in the futures market. The commercial traders, the big banks and institutions that use the futures market for actual hedging rather than speculation, they've been reducing their short positions. Now, that might not sound significant if you're not familiar with how these markets work, but it's actually a huge deal. Historically, the commercials are short gold futures because they're hedging physical positions or future production. They're the natural sellers in the market. But when they start covering those shorts, when they start reducing their net short position, it means they're expecting higher prices. It means they don't want to be caught short when the market moves. And right now, we're seeing commercial short covering at levels that typically precede major moves higher. We're seeing the smart money, the people who actually deal in physical metal, position themselves for a significant price increase. At the same time, you're seeing the speculative positioning remain relatively modest. The hedge funds and CTAs that typically pile into gold at tops, they're not fully loaded yet. There's still room for that momentum money to come in. And when it does, when the technical breakouts start triggering systematic buying programs, that's when you get the vertical moves. This is the setup that produces the kind of moves we saw in the late 70s. This is the setup that produces the kind of moves we saw in 2011. Tight physical market, strong fundamental demand, commercial positioning that suggests higher prices, and speculative positioning that's not yet extended. But there's a timing element here that's critical. Because once this move starts, once we break through the technical levels that trigger the systematic buying, once the physical shortage becomes obvious to the broader market, you won't be able to get positioned at reasonable prices. Think about what happened during the pandemic when people suddenly wanted physical silver. Premiums went from $2 over spot to $10 over spot overnight. Dealers were out of inventory. Mints couldn't keep up with demand. People were paying massive premiums just to get metal, and that was with spot prices that were relatively modest. Now imagine that scenario, but with spot prices that are already elevated and moving higher rapidly. Imagine trying to buy physical gold when it's up 20% in a month and every dealer is sold out. Imagine the premiums you'd have to pay. Imagine the wait times. That's what's coming if you wait. That's what happens when the physical market gets tight and the paper market loses credibility. The spread between paper prices and physical prices blows out, and suddenly you're paying a massive premium just to get actual metal. And here's the thing that really concerns me. The general public isn't paying attention yet. Gold is making new highs, and it's barely making the news. Silver is showing incredible relative strength, and most people have no idea. The mainstream financial media is still focused on stocks, on crypto, on whatever the narrative of the day is. That's actually a good sign if you understand market psychology, because the real moves happen before the crowd shows up. The real money is made by the people who position themselves before it becomes obvious to everyone else. Once it's on the cover of magazines, once your neighbors are talking about it, you're late. Right now, you're early. You're seeing the setup before most people recognize it. You have the opportunity to act while physical metal is still available at reasonable premiums. You have the opportunity to position yourself before the momentum buyers show up. You have the opportunity to get in before the technical breakouts trigger the systematic buying programs. But that window is measured in days, not months, because the physical market is already tight, because the delivery demands are already stressing the system, because the central banks are already buying everything they can get their hands on. Let me give you another historical parallel, because I think this will help you understand the urgency. In 1979, gold was trading around $300 an ounce. It had already had a nice move from the lows. A lot of people thought it was expensive. A lot of people thought they'd missed it. A lot of people decided to wait for a pullback. But the pullback never came. Or when it did, it was shallow and brief. Because the fundamentals were so strong, because the monetary situation was so unstable, because the physical demand was so intense, every dip got bought immediately. And then gold went from 300 to 850 in about 18 months. The people who waited, who thought they'd get a better entry, they either paid much higher prices or they missed the move entirely. And that move, that explosion from 300 to 850, that changed lives, that created generational wealth for the people who were positioned correctly. We're in that same setup now. The fundamentals are actually stronger than they were in 1979. The monetary situation is actually more precarious. The physical market is actually tighter. The only difference is that most people don't see it yet. They're not paying attention. They're distracted by other things. But the smart money sees it. The central banks see it. The family offices see it. The sovereign wealth funds see it. That's why they're accumulating physical metal as fast as they can. That's why they're demanding delivery instead of holding paper claims. That's why they're willing to pay up to get actual bars. And here's what's going to happen next. We're going to see a technical breakout that triggers the momentum buying. We're going to see the systematic funds start piling in. We're going to see the retail investors finally wake up to what's happening. And when all that buying hits a market that's already tight, that's already struggling to meet physical delivery demands, prices are going to move in a way that shocks people. You're going to see days where gold is up $50. You're going to see days where silver is up $2. You're going to see premiums on physical metal expand to levels that seem crazy. You're going to see wait times for delivery stretch out to months. And you're going to see people who waited, who thought they had time, scrambling to get positioned at prices that are multiples of where we are now. That's not speculation. That's what happens when tight physical markets meet strong fundamental demand and momentum buying. We've seen it before. We'll see it again. The only question is whether you're positioned before it happens or whether you're trying to chase it after it's already started. Now, I want to be clear about something. I'm not telling you that gold is going to go straight up from here with no pullbacks. Markets don't work that way. There will be volatility. There will be days where it feels like maybe the move is over. There will be moments of doubt. But the underlying fundamentals, the supply and demand dynamics, the monetary backdrop, the institutional behavior, all of that is pointing in one direction. And that direction is significantly higher prices for precious metals over the coming months and years. The question you need to ask yourself is this: do you want to be positioned before the crowd figures it out, or do you want to be part of the crowd trying to get in after it's already obvious? Do you want to buy physical metal at current premiums, or do you want to pay the premiums that come when everyone suddenly wants metal at the same time? Because that's really what this comes down to. Timing. And right now, the timing is about as good as it gets. You've got strong fundamentals. You've got technical setups that are primed for breakouts. You've got physical markets that are tight but not yet in crisis mode. And you've got a general public that's still not paying attention. That combination doesn't last. It never does. The window where you can act before it becomes obvious to everyone else is always brief. And we're in that window right now. Think about what's at stake here. We're not talking about making a few percentage points. We're talking about the potential for the kind of move that happens once in a generation, the kind of move that happens when monetary systems shift, the kind of move that happens when decades of policy mistakes come home to roost all at once. The people who positioned themselves correctly before the 1979 move, they didn't just make money. They preserved purchasing power through a period of massive monetary instability. They protected their wealth when everything else was losing value in real terms. They set themselves up for decades of financial security. That's what's possible here. But only if you act while you still can. Only if you position yourself before the physical market gets so tight that you can't get metal at any reasonable price. Only if you move before the momentum buyers show up and drive prices vertical. You have days, maybe weeks if we're lucky, but not months. The setup is too perfect. The fundamentals are too strong. The physical market is too tight. Something is going to trigger this move, and when it does, it's going to be fast. So here's what you need to do. You need to assess your situation. You need to figure out what percentage of your wealth should be in hard assets that can't be printed, that can't be devalued, that maintain purchasing power regardless of what happens to paper currencies. And then you need to act on that assessment while you still have the opportunity to get physical metal at reasonable prices. Don't wait for confirmation. Don't wait for the mainstream media to tell you it's time. Don't wait for your financial advisor to suddenly discover precious metals. By the time all that happens, you'll be late. You'll be paying premiums that are double or triple what they are now. You'll be waiting months for delivery. You'll be trying to get positioned after the easy money has already been made. The smart money is moving now. The central banks are moving now. The institutions that understand what's coming are moving now. The only question is whether you're going to join them, or whether you're going to wait and hope for a better opportunity that never comes. History is repeating itself. The patterns are identical. The setup is perfect. The fundamentals are stronger than they've ever been, and the window to act is measured in days. What are you going to do?